and I'm a junior. I'm the outgoing committee head of the Industrials and Energy Committee here at the Colorado Investment Management Group. This past summer, I had the opportunity to intern at Regions as a corporate banking analyst, and this upcoming summer, I'll be at Ducera Partners as an investment banking analyst focused on restructuring and distressed M&A. I have the pleasure to introduce Robert Rabati, the president and the chief investment officer at Rabati & Company, a New York-based asset manager with a deep value focus founded in 1983. He has a Bachelor of Science from Bucknell University and an MBA from Pace University, and he serves on the board of 3 publicly traded companies, Amreport, Tidewater, and Pulse Seismic. At a time when there's much investment interest on companies in the Magnificent Seven, he will speak instead about opportunities in what he calls metamorphosis of the old economy. So please join me in welcoming Robert Rabati.
Thank you so much. Hi, thank you all for being here. It's great to be with people who share a passion that we have, and that is for security analysis and stock picking. So that's what I say. That's what we do. We do bottom-up stock research to identify companies we think the market is substantially mispricing. And where do we look for those? We look definitely in companies that are aggregated in value. And when it comes to value, we're not afraid of deep value. We're not afraid of cyclicals. We think there's plenty of opportunities, and I'll tell you why. The firm itself, I graduated college in 1975. It was particularly fortuitous for me. What that meant was I walked into the office of Tweedy Brown to do the audit since I was a CPA, knew nothing about finance. I took one class, I got a C. So therefore, I wasn't informed the market was efficient. So therefore, I wasn't burdened with that fact. Instead, I saw what Tweedy did, how they made money. And in addition to Walter Schloss, of course, who worked at Graham Newman, was a close friend of Warren Buffett. So I happened to have a great relationship with people with pedigree that I had no knowledge of. I just walked in randomly into this place. After spending 4 years there in public accounting, spending a lot of time at the Tweedy audit, I worked for Mario Gabelli for 3 years. So Mario, at the time when I joined him in 1980, managed $7 million. When I left in 83, it was $77 million. And his business was originally a brokerage business where he was a stock research idea, a sell-side business. So every day he had his morning meeting. And that's what I said. I went to an executive MBA program taught in value investing to me by Mario Gabelli one-on-one for 3 years, and he paid me to attend the class. Of course, I didn't want to be an accountant. I didn't want to run his operations. I wanted to pick stocks. So therefore, I was foolish enough, and no one would hire me to do that. I had to start my own business. So therefore, I started my own business 40 years ago. Okay. Two other important factors in the 40-year period. So in the 40-year period, what's happened is not only have I picked stocks, I also picked people. Or more importantly, I should say people picked me. So people found us based on what we did, and they had a huge interest in the same things we did. So today, there's 14 people who are looking for companies that the market is mispricing and provides us great opportunities, we think. 2 critical people. One of them was Isaac Schwartz. I met him when he was a freshman in college. He worked for us every year as an intern. When he graduated, he took a trip to Asia, came back and said, we should invest in Asia. I said, I'm a kid from Queens. I don't even speak English that well. I'm definitely not going to speak another language, but I went to Asia with him. And that's what happened. He lived a year in Singapore, 5 years in Hong Kong, which was a phenomenal experience for all of us, including me. Because what I did over the 6 years is I would regularly visit him. I'd spend weeks at a time. We visited with 400 public companies all across Asia. So down from Indonesia and the Philippines, all the way up to Mongolia and out to Japan. So that process clearly said the world is flat. All economies are interrelated, and that's a critical part of understanding the domestic companies that we were investing in, separate from what he was investing overseas. The other one is in 2013 and 16, Curtis joined us. So Curtis Jensen was the chief investment officer at Third Avenue Value. So that's what happened. So in 1975, when I walk into Tweedy's office, like that's the opening shot for value investing, right? So you had 73, 74 market correction. And what happened? The Nifty 50, which were great companies, you could pay any price, you were going to make money in them, suddenly corrected and things rotated. And the rotation was a different place because rotation happens, different economic events unfold, different people benefit from that environment. And that's what happened. So 1975 is the beginning. So Tweedy Brown, Ruane Cunniff, Warren Buffett himself, Mike Price Mutual Shares, you go through the list, they all started to have phenomenal performance in 1975. So here, Curtis Jensen had been with Marty Whitman. Marty Whitman, again, a great value investor. And of course, what happened was Marty eventually sold his business to AMG. And instead of being in the performance business, they ended up being in the asset accumulation business. So therefore, the business substantially changed. Curtis left, sat out for 2 years, joined us. So it's another indication of the market for value investing, active stock pickers today, especially ones who invest in heavy cyclical assets. They don't have any capital. They retired. They've set up a family office. They've gotten out of the business. And so that's an interesting dynamic which provides opportunity, we think. So that's what we do. We look at companies that are beaten up and out of favor. And when we visit with them, we visit with management, so we get to know them well, and nobody else talks to them. So therefore, management spends plenty of time with us. So we meet the management, we meet the boards, we meet the shareholders. So we get to really know the company and the business and people well. And part of that process occasionally is we then end up serving on the board. So today I serve on the boards of 3 of the investee companies we have. And that service is great because it gives us more information on the granularity of the business. It gives us an understanding to identify other investment opportunities. And of course, it also gives us input into the process of selecting top management and allocating capital. So these businesses going through difficult times have the opportunity to be extremely opportunistic to deploy capital. So let's set the stage. Why is the opportunity we think so great for stock pickers today? So the first thing you have is huge macro trends. The first one is inflation. When I got out of college, right, since I was an accounting major, there was a thing called NIFO. You know NIFO? LIFO, FIFO, NIFO. NIFO was next in, first out. Inflation was so strong that you couldn't use FIFO or LIFO because when you sold that inventory, you'd book a gain for accounting purposes, you'd lose money because to replace the inventory cost you more money. And so therefore you were losing money. That's how inflation was so strong in that period of time. That's why different people, so of course inflation came down, and of course inflation came down, what happened for 40 years? Interest rates went one way, because what determines interest rates is inflation, not the Fed. Inflation determines interest rates. And the Fed has very little impact really on what inflation is. So inflation came down, and of course, who's the beneficiary? There's a lot of people. One of the beneficiaries is private capital. So what do? Multiples expand dramatically. You leverage those returns. You have phenomenal results. So capital flows to private equity, private capital, because of course that's a hugely beneficial economic period. Today, I'd suggest there's an awful lot of capital that's gone to that end of the hockey rink, and that's where they are. And this business is fundamentally transformed. It's an efficient market. Businesses sell for fair value. You cannot buy a business in this environment because there's a lot of capital chasing transactions. And so that's a very different environment that's happened. And of course, the business is fundamentally flawed because the people who mark the scorecards are the people who manage the money. And when they started this, they were aligned with the investors because they put a lot of capital to work. Today, they're in the asset accumulation business. They're on the different side of the equation. There's huge risk to this business and the capital that's in that part of the capital markets we suggest. So the first chart goes through the idea there are different economic environments, and that changes. And that means the winners are going to be different winners. The likelihood that anything continues for an extremely extended time is odd. Of course, we've lived through a period where it actually has, post the financial crisis, an economic environment had persisted that was very low, similar. So therefore, it was low economic activity, low inflation, no interest rates, and that persisted for over 10 years. And people got to believe that's the new norm. And of course, many people who got out of college 10 years ago, that's the only environment they lived in. And even the people who are older than that have lived through such a long period of time. Even Howard Marks 2 years ago, when he was sequestered with his son, suddenly started to say, well, price really doesn't matter. So a value guy dyed in the wool suddenly was saying, well, maybe it doesn't matter. Of course, valuation matters. That's a critical element. And of course, in the equity markets, right, growth has outperformed such an extended period of time because of that underlying economic environment is one of the key drivers. Conversely, things that are value, so the biggest component of value is financials. If you're a bank, how do you make money when the interest rate is 0? So you don't make money. If you don't make money, you don't perform well. Industrial businesses, it was a weak economic environment. So weak economics meant, of course, there was weak performance from things that are value stocks. So of course they get orphaned in that process. In the meantime, it's exacerbated by the fact that, of course, passive investing is the way to go, right? All the money gets taken off the table and it goes into passive investing. And of course, passive investing, we all know that one of the features of passive investing is valuation is actually an influencer and a push, and it's not a pull. So it's not constraining it. So therefore, and we think that's what we think, even on a go-forward basis, even if you like growth stocks, you're going to have to pick the right growth stocks. It is a stock picker's huge opportunity. Whether you're going growth or value, there's going to be differentiation. But an index, you buy them all, you sell them all, there's no differentiation. Differentiation, security analysis, stock selection is going to be the next decade. That's how you're going to make your money. And that's why you guys are in a great position, because things are going to change and you have the opportunity to participate. So the critical thing we do, so in value, the even value investors, I don't do cyclicals, I don't do commodities, I don't do that. And so, and there's plenty of reasons. They've underperformed, they've been really difficult times. Of course, I'd suggest Mr. Market is more manic depressive when it comes to this business. So you can buy a business for far less than what it's worth, because people don't want to own something that isn't going to make money or potentially is going to lose money for them. And in the same time, there's a cathartic process in going through a period of time, 10 years, where you have poor performance. Capital is constrained, capital is reduced, facilities are shut down, and consolidation happens. And the longer it happens, so in economics, there's the rule that says in economics, things take longer to happen than you think they will. They can happen faster than you think they could, but the longer it takes, the more cathartic the opportunity is, because the more consolidation happens. So we'd suggest you can buy businesses for not, who wants to buy $1 for 50 cents? That's not what we're looking to buy. We're looking to buy $1 for 30 cents, 20 cents, 10 cents. But more importantly, what we're looking for is that cathartic process, that consolidation, that change in the business. Are those companies now suddenly an oligopoly, and the industry structure is different, and therefore it's a different business with a different opportunity. So that's what we think. There's a huge cyclical recovery, but more importantly, there's a huge secular recovery, because the world's economic environment is in the process of dramatically changing. The winners are going to be different than where they have been. So that's what we talk about, right? We don't talk about the revenge of the old economy. We talk about the metamorphosis of the old economy, right? There are companies in North America, industrial-based, that today there are 3 people who control 90% of the market, and they're competitively advantaged because they are the low-cost operators on a worldwide basis. That's a fundamentally different business. But people say, oh, I own that business. That's a cyclical business. That's a commodity business. I don't want to invest in it. The numbers are there. It's already demonstrated that this is the case, because we know the numbers are demonstrated, because our results on a 1-year, 3-year, 5-year, and since inception basis, we've outperformed the market. And we've outperformed the market. I consider the market to be S&P 500. So we've outperformed the S&P 500 on a 1-year, 3-year, 5-year, and since inception basis, picking industrial heavy industries. And today we think there's 2 huge major macro themes that our research tells us. Our research is, we think, grassroots macroeconomics. So looking at a business, you understand an industry, you understand a component of the economy, and therefore you are clearly drivers. And the capital intensive means these are long dated trends that are in the process of unfolding. 2 trends we see clear. One of them is globalization 2.0. It's not deglobalization. That's an absolute mischaracterization. Globalization is a continually evolving process. And of course, it's evolving past China. It's accelerating past China for other reasons too. So we think there's a huge movement, and it's been going on the way for 10 years. There are plenty of businesses that have migrated out of China to other places, Southeast Asia or India. So we think there's a huge opportunity in that part of the world. At the same time, energy transition. So we've been energy investors since 1976 in fossil fuels. The reality of it is the world needs more energy in all forms. Renewables are clearly going to be a huge component of the growth going forward. That renewables, to build out, there is a huge call on all kinds of commodities, like steel, like cement, like copper, all of these things. For the next 10 years, there's really going to be a strong secular demand for those things. And of course, that energy transition means North America is competitively advantaged. If it's an energy intensive business, North American energy costs are far less than the rest of the developed world, right? There's an abundance of natural gas in North America that you cannot transport. Therefore, pricing here is disconnected from the rest of the world. An energy intensive business in North America is competitively advantaged against anybody else. That's a huge macro trend. And these businesses that people think of as cyclical businesses suddenly have secular changes, but this structural change also. China's a very different place. So that's what we say is that inflation over the last 10 years came down, 40 years. So interest rates came down, and it had nothing to do with the Fed. It had nothing to do with Volcker. It had to do with China. China made everything cheaper than everybody else in the world. You know, back in 1992, when Clinton won, the critical thing was Ross Perot ran for president, and he talked about the giant sucking sound, because all these businesses were going to go to Mexico. He was wrong. The giant sucking sound lasted for 40 years, and it was China. Right? It took jobs and industry, but it took inflation out too. So therefore, Walmart became a great business because you could buy things that were made in China cheap. So inflation went away because of that structural change. It's not, Volcker didn't do that. And yet China today is a very different place, right? The demographics are horrible there, the wage rates in Mexico are less than they are in China. So therefore, North America is competitively advantaged. China is a different factor than what it was. And without a doubt, the last 40 years, that's maybe interest rates, but that's the other thing that has had a huge effect on the world's economy. This is just as that migration happens, as you move to the 2 billion people who are in Southeast Asia, and that's what's happened over time, right? That post-World War II, first it's Japan, then it goes to South Korea, then it goes to China. So it continues to move south and west, and now it's going to Southeast Asia and India. As you start that economic ascent, those people become very energy intensive. And China's the great example of energy short. The world is short of energy. And that's because Xi, after, right, he made that big public spectacle and kicked out the number 2 guy in the Congress a year and a half ago, then said, here's our policy on energy. We will build renewables as fast as we can. And China is building renewables as fast as they can. Then, of course, he turns around and says, and we're also going to build more nuclear power plants. We're also going to build more coal plants. The fact of the matter is you need all of those things because the power demands for the world's population is going to be strong. That's a huge call on capital, and it's a huge call on materials. And so that is inflationary. And then that's another aspect to what we think potentially unfold. This, again, this industrial revolution, North America competitively advantaged, right? Gas prices have come back down in Europe. They're down as low as $7 an MMBTU. It's okay, they're $1.50 here in the US. So they're a fifth of the price. So the spread between US, North America, I always say North America, not US, because it's Canada and Mexico are part of that equation. There's a huge difference, which means there's a huge, and that's what it is. It's not reshoring. That's, again, a misclassification, because it's not coming from China back to America. It's coming from Europe to America, because we're competitively advantaged, and the Europeans know that. And that is a sustainable difference. It's at least 10 years that we have much lower energy costs. And of course, if Biden's successful and we don't have extra LNG to export, it'll be 15 to 20 years that we'll have a differential of huge proportion in terms of lower cost energy. And that means industrial America is hugely competitively advantaged. So the company we have is just one of many that's an industrial business. It's a fertilizer manufacturer here in the United States. On a trailing basis, single-digit PE multiples, trades at book. The earnings have come back down because prices have moved around. And when that happens, everybody freaks out. The stock trades down. So the stock now trades at 7. It was as high as 28 2 years ago. And we think it trades at a fraction of what the business is worth. The interesting dynamics are, this is a picture of where they do business and what the products they sell. But here it is. So since they use natural gas in North America, there's a 350 to 400 ton cost advantage they have in the manufacture of ammonia here. And ammonia is the intermediate product that you make to make fertilizers. And if you do it in China, you use anthracite. So not only do you have much higher costs, you also have a much bigger carbon footprint because you're using coal to make those products. So there's a huge differential advantage, which is sustainable, which means outsized earnings for North American businesses. And you see that because Yara, the biggest fertilizer distributor around the world, is building 2 new plants. Where are they building them? In North America. So there's plenty of activity, industrial activity, moving here, and more of it's really coming from Europe than it is someplace else. So the competitiveness of America is very different. In addition, this industry is part of energy transition, right? Because ammonia is an interesting product. That's the intermediate product they make to make fertilizer. Ammonia has 3 potential new uses in energy transition. The first one is marine shipping. There's a problem with ships. They burn fuel. The IMO, which is a part of the UN, is saying you have to reduce the carbon footprint. So therefore, there are plenty of engine companies that are working on methanol and ammonia as a substitute fuel to burn to power that shipping. So that's one use. Another use is in Korea and China, Korea and Japan, they're already doing test burns, pilots, where they're substituting at 20%, 30% ammonia along with coal. So therefore, when it burns, it doesn't create CO2. It reduces all the other pollutants that come along with burning coal. Clearly, Japan's a place that doesn't want to burn coal, but is forced to because they shut their nuclear power plants. So therefore, that's a new use. And the other one is, everybody talks about hydrogen. Hydrogen is a difficult commodity. How do you transport? How do you do that? It's much easier, and ammonia is more stable. So there are plenty of uses where you're building a plant in Dubai that's going to build 2.5 million tons of ammonia a year. They're going to ship it to Europe. When it gets to Europe, they're going to convert it to hydrogen. So it's a bridge fuel to be able to facilitate hydrogen. There's a shipping company that's building a power generation that has ammonia. They then takes the ammonia, they convert it to hydrogen to power a fuel cell. So there's new uses for that. So there's 3 different uses that potentially more than double the demand for the intermediate product they make, ammonia. So there's a huge growth case that isn't kind of factored into this business. The business itself, it trades for a third of what the assets are worth. There's two transactions going on, which indicate value. In the meantime, I told you, Yara is building 2 new plants. OCI is building a plant. They're building it here. When you look at what the capital cost to build out those plants are, which they clearly think are economic, that it indicates the value here. So this thing trades for a third of what the assets are worth. That's what we look for. Can you buy assets that are extremely economic for far less than their replacement cost? Because the replacement cost will indicate the earnings power of that business. And this is the perfect example. In addition, because of the growth of ammonia, there's also this other thing, which is how do you make ammonia? Today, most ammonia is called gray ammonia because you're using some kind of fossil fuel to make it. What you can do, though, is blue ammonia is when you capture the CO2. So they're in the process of installing on one of their plants on an economic basis, which gives them a return based on the Inflation Reduction Act, a credit, which therefore makes that economic, and then they'll capture 60% of their ammonia. And when they do that, the ammonia they make will be blue ammonia, which will definitely have a higher demand and probably higher pricing. Who knows how much? But as importantly, here you have a Japanese utility, a power company that is looking to do a joint venture to double the size of their plant. In that process, the $800 million would cost to do that. The federal government will finance 60% of it under the Inflation Reduction Act at a low cost of interest. In addition, they have the partner. So if we're putting up somewhere between $150 to $200 million, they can double the capacity. In addition, the contract would be a very different contract because they would sell an offtake agreement with those power companies, which take a spread, natural gas price plus a margin. So I got a guaranteed profit. And I have an offtake agreement with a high credit quality Japanese Korean utility, and I don't have volatility in my profitability. Instead of selling fertilizers, they go up, they go down, I make money, I don't make as much money. I change that earnings stream, so I've got a stable earnings stream, substantially larger. So there's huge growth opportunities, conversion in the income piece of the business. You buy the business for a third of what it's worth, and that is a story replete across industrial America. So we think there's a huge number of opportunities. Questions?
Let me just, so 2 things before we take questions from Bob. Number 1, for those of you who aspire to go work in New York, get used to that pace of speaking because it happens much more often in New York than you will find certainly in Alabama. And number 2, kind of a life lesson. I hope all of you, when you're 50 years into your career, have the same amount of enthusiasm Bob has for his career right now. So anyway, with that, we learned a lot about LSB Industries. We learned a lot about different types. I mean, just about every presentation today has been talking about let's find good, competitively advantaged, high quality companies. And there's a lot of really good ways to make money investing in those types of companies. But as a lot of people have also said, there are a lot of ways to make money as an investor. And you have to find out what's good in your hands, what makes sense to you. And that's why days like this are good, because you get to hear the different ways people think, the different ways people do things, and what you will develop a sense of what makes sense to you, and that will probably be what you're better at. So anyway, with a little bit preface, any questions for Bob? We've got one down here.
And I brought back to the first page because you do see I say Capstone Investment Conference to date, and I say bringing together the super investors of tomorrow today.
Thank you so much for the talk. My question is about there's a trend with a lot of companies that they're building more redundancy in their supply chains. They're building factories. If they're building a factory in Southeast Asia, they're also building a factory in India. And I think especially so for energy companies, there's a high fixed cost in building those plants, and that might eat into their margins a decent amount. So I was just wondering, what do you think about that, and how that ties into inflationary environment going forward globally?
So the first thing I want to say, it's inflationary, first off, right? If you move and you put new capacity in a new place where it wasn't before, the fact of the matter is China will be a great economy. This is not the decline of, China will be like America was. 40 years ago, we were competitively disadvantaged. The American economy didn't implode. So the Chinese economy will grow, and the growth of the Chinese economy means there's going to be all this material to do. In the meantime, when you replicate what they have, you cannot do it as efficiently as they did. And so it's going to cost more money, and you're going to have to build out the infrastructure. So therefore, that's going to be costly. And you're going to have all of the materials you need to build out infrastructure. So the call on those commodities, which are already in tight supply, means that's inflationary. So that isn't really answering the question that you had. The question that you had really was, is there a problem with energy companies and profitability because that'll constrain margin because the returns won't be there? No, you won't build it if the return isn't there, is what I would suggest. And therefore, it will be priced in, and that will be further inflationary because you will want that second alternative to your supply chain, and it's going to cost you more money, right? People are going to build chips in America. People are going to build solar panels in America. Well, you know that's going to cost 2 to 3 times more money than if we built it in China. So that's part of that equation, and you have to accept that, and we are willing to accept that. That is inflationary. So we think, we think the risk of inflation is something that, even though people saw it 2 years ago, have now like looked past it. We talked about Brigadoon, right? That's a play that Lerner and Lowe wrote. There's a place in town in Scotland. They came across it. It was in the moors. It was a wonderful town. They come back the next day. It's not there because it only comes up 1 day a year, 1 day every 100 years. Financial Brigadoon. For 10 years, people thought there was no inflation. Interest rates were low. They're going to stay there. And it's come back down. It's looking, oh, maybe that's going to be the case. We don't think so. We think that that really is a mirage, and it won't be there. And inflation is normally part of the economic existence we all live in. And the fact that you got out of it. Even people who've been in business forever said, oh, no, things have changed. Things are different. Technology, all these things, wonderful efficiencies. Therefore, there's a limit to what those things can do. And so, and they may not be inflationary in aggregate, but this part of the market is inflationary because of the call on limited commodities, because we live in a tangible world still with physical items, even if we live in a digital world.
Okay, very good. There's another one back there.
Hey, Mr. Body, thank you for the question. My question is, as you said, with the Henry Hub trading around 150, where are you finding value in these natural gas producers? Is that going to be operational efficiency or management team? Because I know they've been beaten up pretty bad the past couple months.
We think that natural gas companies are really interesting because I think actually over the long term, we will figure out a way to get more connected with the rest of the world. And therefore, there's a temporary lull in where the price is today. The fact of the matter is, if you go to Canada, and that's where I think there's actually is more opportunity in Canada in oil and gas in North America because there's more of it there. It's cheaper. You could drill a well for next to nothing for 25 cents, and therefore you're still going to make money. And Canada is in the process of changing because they've always had the poor problem of having to sell to America that's oversupplied, so they always get the worst price. There'll be an oil pipeline that they're extending 600,000 barrels to sell to Asia, and in a year's time, they'll sell 2 billion cubic feet a day of natural gas to Asia. So therefore, accessing world markets for them is going to be hugely accretive. In the meantime, those stocks have net cash on the balance sheet, generate free cash flow, take 50% of the cash flow, reinvest it, grow production 5 to 10%. They're growing the asset. The balance of the money, they buy back stock and pay dividends. So there's high dividend yields, there's stock reduction in the per share count, and there's a 20-year inventory that they have. So that business is converted from one. Oil and gas business is a declining business that has a finite resource. The fact of the matter is Canadian oil and gas companies, in my view, haven't gone to Canada for the last 20 years, and they're 5 times a year. No, it's a long-dated 30-year opportunity they have. It's not. It's a perpetual business today. But therefore, the multiple should double just in the fact that it's a perpetual business as opposed to a declining business. But it hasn't done that because nobody wants to do that. Nobody wants to go to Canada, and that's what it is. What's going to happen is the opportune set for what the valuations of those companies are totally disconnected from the economic cash flows of those companies. As Boone Pickens made a lot of money back in the 80s saying, oil and gas is available in the stock exchange for far less than what it costs you to buy those assets. So it is a bargain sale with companies that are financially strong and have net cash, many of them. So therefore, relatively limited risk if there's some problem in the short term because you don't have a financial risk. This is not a levered business. These are unlevered businesses generating free cash flow. So therefore, you've got downside protection in that process too.
That was fantastic. Thank you.
Yeah.
Okay, I think we have time for 1 or 2 more. There's one there.
Yes, thank you for your presentation. You gave a thoughtful point about how it's going to be a good time to be a stock picker again. But I'd love to hear your thoughts on how this emerging group of stock pickers should plan to compete against artificial intelligence, given that it would be low cost compared to the cost of a person.
There's 100 companies that I know trade for far below what the present value, the future cash flows of the business are. So you don't need to have artificial intelligence. You could have just human natural intelligence. And there's a plethora of things for you to invest in if you get over the limitation of, oh, that's a commodity cyclical business, and understand that dynamic is very different. And it's really the cash flows that are the critical element. And so I don't see how AI, I don't know how AI unfolds and clearly do wonderful things. I'd suggest, of course, that a reporter from Reuters asked me the other day, he said, so why do you think that value is going to outperform? Because that's what I do think. I think the value is a Cinderella story, right? The stocks were orphaned because they performed poorly for 10 years. So of course they get orphaned. The fact of the matter is the fundamentals are different. And so suddenly there's a new prince in town. He sees Cinderella for who she is. If you see Cinderella for who it is, and don't look at artificial intelligence, you don't have to do anything to make a lot of money, I'd suggest. And have, because Bernard Baruch said 100 years ago, he said, data and information is no substitute for thinking. If things change, if the underlying economic environment is different, if the fact patterns, if money is flowing based on what has happened for 15 years, and it's a different environment today, don't look at past data. I love things that say, oh, in 3 of the last 4 times, this is what's happened or whatever else, and therefore it'll do this. I was like, wait a second. It's not the same road. You're on the wrong road. You're on this road now. Don't look at what that fact pattern was. That's irrelevant. Don't give me data. And everybody has data. Everybody has information. And everybody has analysis of that data. Stop. Think. You need to think critically. That's the differentiator.
I think we should stop on that note. So thank you, Bob.